All right, thank you. Welcome everyone to the primary language of the market. This is a basic foundational course, which probably isn't so basic really, where we're going to look at reading bar by bar. So just a couple of quick preliminaries before we get going here. One is that I think about two or three traders had sent in emails that we tried to send back slides for tonight, a copy of what you'll see on the screen so that you could take notes and you've got a record of it for yourself. But those emails were not good emails. They kept bouncing. I tried a couple of different times to send material to those emails. So, and I have no way of getting to you without a correct email. So, if you did not get the slides tonight, then send Helen a email requesting the slides. And her email address is helen@tradingpsychologyedge.com. Okay, helen@tradingpsychologyedge.com. Yeah, everybody should have gotten them. I sent out about 3 batches today, starting at the afternoon. Okay, so that's that. Second thing to note is that this is copyrighted material, so please don't distribute this. Put it up on, especially on the torrent file sharing sites and that sort of stuff. I would appreciate that. That's important to me. Also, in the U.S., we need to just remind everybody that trading is a risky business, and that you really need to consult with a financial advisor before making any trading or investment decisions. And of course, you're responsible for your own trading and your own investment decisions. And that's that. All right, so we will. Here's what we're going to cover tonight. And this is the first of 2 parts, 2 sessions. We'll go an hour and a half, probably a little bit longer than that, because I can get into as most of you know, who've been with me in a training session before, I can get into some detail on this stuff. And when we are reading price bars and volume, it's all about details. The devil is in the details, and so you've really got to pay attention to it. So if we go longer than an hour and a half, I'll apologize up front. I'll try. We can stop. If it gets to be too long, we'll just stop and pick up on Saturday. The second session will be on Saturday at 4 o'clock Eastern Time, and everything is being recorded. And you'll have a chance to ask me questions at the end. I've got 2 questions for you that I want you to consider, and if you feel like it, to respond back to, and we'll answer those questions on Saturday. So tonight, what we're going to talk about, we're going to go through the basic language of price and volume so that we can all sing off of the same song sheet. Okay? Well, it's very basic, but I want to make sure that everybody's got that. And then we'll take and look at how we use price and volume in a hypothetical example, a hypothetical chart that I put together. Then we'll start looking at real charts. And the first thing we're going to look at is low demand at a top. How to tell a top after a rally when the demand has tired out. We're going to look at we're going to also look at when high volume comes in, when it's supply, okay? And not, some people just love to jump in and buy whenever there's high volume, or sell whenever there's high volume, and that's not a good idea. I want to pay a lot of attention to that, because there's always a lot of confusion around high volume. And so we're going to spend time on high volume because it's very, very important. We'll talk about stopping volume. Once we've seen supply come into a market, we're going to talk about what it looks like, what the criteria are for a market that's unable to rally. Okay, it's very important. I mean, just with that kind of knowledge alone, you can begin to develop a trading plan or a trading setup for yourself. We'll look at climactic action, which usually involves high volume. And when we're talking about high volume, we're also going to talk about the spreads or the range of the bar as well. Okay. Somebody says no sound. Does everybody else have sound? Can you all hear me okay? Yeah, everybody else has sound, so that person will have to stop it. Stop it. No. That person will have to just log back in. We'll talk about the characteristics of a rally. That's important too. How supply shows itself at the top of the rally. We'll talk about where low demand at the top of the rally first, and then how supply shows itself when we see a rally. How a down move is stopped once we're moving down. What does it take, and how can we tell that a down move is the brakes are being put on to a down move? We'll take a look at accumulation. We'll take a brief look at distribution too. I'll probably do distribution more so on Saturday. Tests and testing. Oh, how important is that? We'll just spend some time on that tonight. We'll talk about no demand, which is sort of the corollary of testing. Testing occurs at bottoms or on a good rally. No demand occurs at tops or on a good market decline. We'll see these principles not just on daily charts or weekly charts or intraday charts, but all three of those charts. I was even going to put up some annual charts. I've got some specialty software that has a yearly chart, but I decided not to do it because I figure most people don't have that. But the principles work on all time frames. And you can see different markets, equities, currencies, commodities. We'll cover a bunch of different markets tonight. The point being is that this stuff works on all actively and freely traded markets. There's not a market I've ever met that it doesn't work on. That includes Forex markets. You would just use tick volume instead of real volume. Good studies have been done that show that tick volume is highly correlated with normal volume, regular volume. We'll take a brief look tonight at the Weiss wave. We'll spend more time on it on Saturday. And then I'll give some additional information on the dog. Yeah, you hear on the high volume. Paul says that he hears the dog. And yeah, the dog, my puppy Asta, he's right here beside me. He's always with me during the day and nighttime. He's a great dog. And now it's nighttime here where I am, and it's very cold. It's about 9 degrees Fahrenheit out. I don't know what that would be Celsius, but it's very brisk and bitter. And the deer migrate across the lower part of our property, and he's always on alert, thinking the deer are going to attack us. All right. So price bars, very simple. We have a high and a low and a close, okay? And then we have what's the spread, what we call the spread. English, the English folks call it the spread, the British folks call it spreads. The Americans tend to call it range. I go back and forth. Either or both are fine, but the spread or the range is simply the range of the bar or the spread of the bar. It's the difference between the high and the low of the bar. Okay, now before anybody asks, why? Yeah, no, somebody already did ask. Why no open? Okay, no open because it really doesn't add to our analysis of the charts. No candlesticks, Japanese candlesticks, because what I have found in my own work is that they really don't add to the analysis of the chart. In fact, what I found in candlesticks is, and I find it not only found it in myself, but I find it with traders that I've worked with, and when they're using candlesticks, they're looking for, I don't know, bearish and bullish engulfing patterns, 3 dancing crows and 4 drunk sailors, or whatever some of those, they're looking for patterns, and that's not what to look for. You've got to get your head out of that idea. And you've got, when you're reading bar by bar, and you've got to look for specific. This is very logical. Asta, I'm going to put you in the other room if you don't stop. This is all very logical, and you'll see that as we talk about it tonight. and introducing things like patterns, candlestick patterns, and the open that doesn't add anything, just makes it more cumbersome to try to understand. So it's not worth the distraction. Yeah, George says too much distraction, and I agree with that. Okay, so when we look at price bars, we've got four basic things that we're looking at. We talked about the spread or the range being the difference between the high and the low of the difference between the high and the low of the bar. Okay, so we can have a wide spread, we can have a narrow range, or we can have an average range or spread. And we're just comparing the last few bars. There's no magic number, 4, 5, 6 bars. You know, it should stand out to you. If it's not standing out, then it's probably average. If it does stand out, then it's either wide or narrow. Okay? And they have significance, and we'll talk about the significance of those. But that's what we're looking at when we look at the spread. Is it a wide spread? Is it an average, like the last few bars? Or is it fairly narrow? We're looking at the direction, whether it's up, down, or basically level from the last close. So when we are looking at direction, we're comparing the current close, the close of the current bar, with the close of the last bar. A close on the current bar that's above the last bar is an up bar. Okay, the direction is up. If it's below if the current close is below the last close, the close of the last bar, then it's a down bar. And if it's about the same within a tick or two, then I would call it a level bar. Okay, direction not moving much. Then we're also looking at the close within the bar itself. Is it closing on its highs? Is it closing on its lows? Or is it closing somewhere near the middle? Okay. And then we're looking at volume. And volume can be heavy, light, or about average. And you know, you can I used to track volume with a 20 bar average with Bollinger Bands set at 1 and 2 standard deviations above the mean. That is an okay way to do it, but you can just eyeball it. I certainly don't use those averages any longer. You can just eyeball it and see. So again, we're just looking at the last few bars, the volume on the last few bars, and it should stand out to you as well. So now with these characteristics, we have a language that we can use. We can have a widespread up bar that closes on its highs on very heavy volume. Or we could have an average down bar that closes in the middle on fairly light volume. Each of those will mean a different thing, okay? Depending also on where the price bar occurs in the context of the market. The market structure in the background is always very important when we're reading price bars. We can't just look at a naked price bar and say, oh, well, the direction of the market is now going to be up, or the direction is now going to be down, or they're buying or they're selling. We have to look at the current bar in relationship to what's going on before, the last few bars and the bigger picture. You know, if we're in a trend and we're pulling back and we're making average to narrow range bars, the direction being down on them, they're closing in the middle on light volume, it's saying that there's no supply there. But we want to look at price bars as we go, instead of just talking about it. Instead of just talking about it, we're going to look at them. Is that kind of clear to everybody? Does everybody get what I'm saying here, just in concept? And we're going to do some examples so that everybody's on the same page here. Okay, good. So Linda says, in an uptrend, does the top of the bar have to be higher than the previous bar, or only the close matters? Well, it depends, Linda. It's all context related, and we'll talk about some of those contexts. All right. can I define a high closed bar and a middle closed bar? Yeah, I'm going to do it now. We're going to just jump to a hypothetical chart. All right, and let's just go through this. And as we do, what do you look at bar number 1, okay? Now, how do we define it in terms of spread? Let's talk about that first. Is this a wide spread or a narrow spread, or is it about an average spread? And we've only got 2 other bars on the chart preceding this, so we're going to only compare it to those 2 bars. We don't go forward in this, right? So it's an average spread, says Paul. Absolutely. Looking back, it's just average. It's about the same size. We're just eyeballing here. We're not doing anything fancy in terms of mathematical calculations. We're simply eyeballing our current spread or range, and we're comparing it. We've got 2 bars here, so we're comparing it to the last couple of bars, and we're saying, okay, it's about the same. So we call it an average spread, and it's closing up, right? It's an up bar, closing near its highs. Not quite on its highs, but pretty close to its highs, okay? It's in the top 25% of the bar. You can use that as a, if you need to have that as a marker, as opposed to, we'll see some mid-range closes in a few moments, okay? So, and it's also showing on above average volume, I would say. All right, if we took the last 2 bars and we said, well, averages, maybe if we just kind of eyeballed between, we're maybe almost twice, not quite twice the average volume. So we're starting to see above average volume in here. Okay, I wouldn't call it heavy volume, but I certainly would note that it's bigger than the last couple. How's that? Does that make sense to everybody? Does everybody see that? Okay. The next bar, let me just do this for you, just quickly. The next bar is, again, about an average. Maybe it's starting to narrow a little bit, about an average bar, above average volume. It's closing near its highs, okay, above the middle anyway, but it's closing level, okay, so it's a level bar, average spread, above average volume, level with the previous. Now, I would note, okay, if I were watching this market and this market were happening here, well, I'll say that in a minute. Let's go to number 2. What do you notice about number 2? What's the spread? What's the volume? Where is it closing? What's the direction? It's a short? I don't know, Marilyn. I don't think yet. Okay, it's a small range. Okay, narrow range, right. Up bar, good. With higher volume. Good, Linda. See how the volume's building here? Volume's starting to build. Okay. Smaller spread, closes, I would almost call it level, but you certainly would say it's an up bar compared to the last couple. You could certainly say that, or you might say it's level. It's kind of 6 of one, half a dozen of the other. But we certainly notice the narrow range in here, okay? One of the things that I'd be noticing, that I was going to say when I was discussing this bar, but one of the things that I would be noticing is that here we are, we had a down bar here, right? This was down. Remember, the close is lower than the close before. And in fact, on this day, most likely what happened was the buyers tried to push the bar up, tried to push price up above the high of the previous bar. And sellers stepped in and sold it down, not just below yesterday's close or the prior bar's close, but also near its lows, near this bar's lows, though not a lot of volume, okay? So there was some supply, there was some selling here, had to be. But the very next day, sellers couldn't even take it down to the low of this down day. I'll put a D here for this down day. Sellers couldn't take it down there at all. Instead, buyers came in and pushed it right up and closed it firm, closed it near its highs, and we see good volume come in. Okay. Next day, sellers pushed it down a little bit, but buyers wouldn't have it, and they couldn't even get it down to the day before's low before buyers stepped in and pushed it up, and again volume was sustained there. And then the same thing here. So what I see, let me erase this. What I see in this, just from the beginning of the chart to bar 2, is that the lows are lifting. Okay, the lows are lifting. And as we progress here, I see that the closes are firming up, that selling is not pushing this market down, and I'm seeing volume start to build. That generally is very bullish behavior. Very bullish behavior. Okay? And this is the kind of detail we want to go into when we're studying a chart, bar by bar. We're looking at what the market is telling us, and we're trying to do it in a logical way, and in a way that gives us some insight into what is likely to happen next. And now, believe me, not every price bar I look at, and I can't, there are a lot of price bars I can't figure out. And I just have to wait until, one comes up that shows me a little bit more clearly what's happening in the market. And that, so don't try to read every single price bar. That's kind of a fool's game. You want to look for some of the obvious stuff, but you also want to pay attention to the details, like I'm trying to show you here. Okay, some of the little subtleties that go on. All right. Robert says an up bar is defined by the close of the bar in relation to the prior bar. That's correct. Okay, textbook looking absorption. That's right, Paul. We don't know what's going on in the behind this chart. It's a hypothetical chart anyway, but certainly we see the lows are lifting, the closes are firm, and the volume is building. That's classic bullish behavior. Okay, so now how do we describe bar 3? Widespread up bar on above average volume. That's right. Where is it closing? Widespread. It's closing on its high. That's right. Okay. And it's got heavy volume coming in compared to the last bit of volume. And you can see that. You don't need fancy calculations to be able to see that there was tremendous amount of buying on this. Okay. Now we want to try to relate the bar with the volume, the price with the volume. We have a wide spread here, and that denotes a lot of activity. Okay, and we have a lot of volume. That also denotes a lot of activity. There's a lot of trading going on. Okay, and what this says, because the spread is wide and we close it firm, what this says is that buyers were willing to chase price higher. Okay, they were willing to pay up. They were willing to buy up. As price kept going higher during this day, assuming this is a daily chart, buyers kept stepping in and pushing prices higher, and sellers had no chance here. Okay, so this is very bullish behavior, and it's what we would expect in terms of a breakout above some resistance. Obviously, or clearly, there was some resistance along in here. Either selling was coming in or buyers were checking. They weren't going up higher than this. Either way, it denoted some resistance. On bar 3, we broke through that resistance, and this is exactly what we want to see when we break through resistance. The next bar, I didn't label that, but look at what happens. Sellers came in, they drove it down, but buyers would have none of it, and they brought it right back up and closed it firm again. Okay, so I'd call this a level bar on good sustained volume, widespread still. It's a little narrower than the other bar, and it's an inside bar. I understand that, but compared to the last bunch of bars here, this has got to be in the widespread category. Okay. Rama, how are you? You say it's worth emphasizing the point that up or down bar is defined by the close to close comparison. That's right. That's right. So so for example, bar 3 clearly is an up bar because it's closing above the bar 2. Bar 1 is an up bar because it's closing above here, okay? Bar A, we'll call this, is a down bar because it's closing below this bar. So we're always looking, when we're trying to determine direction, we're determining direction from the last bar, okay? And here, it's probably up, it's probably a tick or two up, but I would just call it level, okay? I would just call it level. All right, what happens at bar 4? What do we see here? It's an average spread up bar on above average volume, closing near the high. Right. Exactly right. Average up bar. Right. So again, we're just taking this spread and we're comparing it to the last 3, 4, 5, 6 bars. So certainly these are widespread. Certainly these are kind of narrow. And we would say, okay, that's about an average spread. Okay. What about the volume? Volume is high. It's the highest we've seen so far. What is this telling you when we're looking at this spread here and we're looking at the volume? What does this logically tell you, particularly compared to the last couple of bars? And really the last bunch of bars, but in particular the last. Okay. There's so many people in this webinar. This is going to be a challenge to keep up with you guys. Let's see. Lots of pressure, says Marilyn. Yes, buyers and sellers are starting to equal. Demand is overcoming supply, but demand is waning. There's some sellers coming in, says David. Selling is starting to step in, says Howe. Sellers stopping it from going higher. Yeah. Okay, I think y'all got that pretty good. So just let's be clear on this, though, because this is really important. Look, on this bar, on bar 3, we have this much volume, and we made this much progress. Okay? On bar 4, we actually have more volume than we have on bar 3, but we make only what? Maybe a little bit more than half the progress than we made on 3. But it's on more volume. So that can only mean one thing, and that is that somebody's selling into the buying. Buyers are still in control because it's an up bar closing on its highs, right? Compared to the last bar. It's still making progress up, but it's not making as much progress up. This is one of the subtleties that we look for in a trend, to give us a sense that to give us a clue or a cue that the trend may start to be over. It's not something we would jump in and short on here, but we would note this, and we would start to be, we'd bring our stops up a little bit maybe, or we'd be more close to the market and watching this a little bit more carefully as the next few bars unfold. Okay? So what happens at bar 5? What do we see here? Is that Wyckoff's effort versus result? Yeah, David, it's a form of effort versus result. That's right. And this is how we see it. We see it in the price and the volume. Good volume coming in, but we're not getting good spread on this. We're getting a comparatively poor spread. And so we're seeing supply entering the market. So Paul says the spread has gotten back to average, and now it's still an up bar, right? The close compared to the last bar, but our spread, our close is now in the middle. And look at the volume; it's bigger than volume 3 on bar. It's bigger than the volume on bar 3. And again, that's our kind of standard here for this chart. We made good progress up on that volume on 3, and now at 4, not so good progress. Now at 5, buyers are no longer able to hold the close at the top. Right? We see sustained volume there. So this is evidence of supply coming into the market. Bar 6 is the same thing. Buyers try to bring it up and push it up above the high of bar 5, but they fail and they come back down again. Okay, and volume is still pretty good. It's starting to decline now, and in this instance it would indicate that there's probably less demand up here, and sellers are starting to fill themselves up. Let's talk about bar 7. What do you see there? What do we see on bar 7? No demand. Yeah, why do we see no demand? What indicates that this is a clear lack of demand? The narrow spread and the low volume. Yeah, look at the spread. Suddenly, we're back to that narrow spread bar, right? It's an up bar. It's closing up a little bit higher than the previous bar, 6. But look at the volume. Tom Williams uses a rule of thumb that lower volume than the previous 2 bars would signify a no demand bar. You just would note that buyers are tired out here. They lifted the market at 3. They struggled but continued to push at 4. Sellers start to come in at 5 and 6. And now on this bar, buyers are spent. There's just nothing left. And we know that because of the narrow range, the close, which is generally in the same area, right? We're not making good progress here. And think about it this way. Look at all this volume. And really, let's clear this and be a little bit more clear. These are about all the same area of close, right? We're not making the kind of big strides up that we did previous. We're not making hardly any stride up. And we can also see that the tops are getting, less and less. We're making less progress up. Let's just show you this. From the last high to this close, we made this amount of progress. Then we made to this high or close, it doesn't matter really, this amount of progress. Then we made this amount of progress. And now we made that amount of progress. That's what we call shortening of the thrust in the price bars. This is significant. You can see that all this volume coming in here is not moving the market on a close basis. And on a high basis, the highs, we're seeing less and less progress. Okay? That's supply. That's selling. Somebody's in there selling. Y'all understand that when an order comes in to the market, it's met by another order to either buy or sell. And on bar 3, the buy orders were swamping the sell orders, and that's what drives this market up. On bars 5 and 6, beginning at 4, but clearly at 5 and 6, there were still buying orders coming in. There's still buyers present, but there are more sell orders to meet the buying. And that's why we see this starting to cap and starting to round over. That selling is coming in, and it's pushing this. It's not letting the buyers continue to drive the market up. If there were no sellers, the market would continue to push up all this volume, right? But it's not. So it has to be selling. There's no other way. All right. And as David says, on bar 7, the light volume tells us that the buying is spent. Okay? And now we look for an opportunity to short when that occurs. And so we see one on bar 7. I'll just talk for a few minutes because I don't want to spend too much time on this. I want to get to some real charts. So on bar 8, we see after the rolling over that the market got rallied up above the highs at 5 and 6 and 7, but they couldn't hold it. And they came down, and we see it closing. It's a down bar, closing on its lows, and it's kind of wiping out on one bar almost a week's worth or 4 days worth of 4 bars worth of progress up. Okay, So we have a widespread down bar closing on its lows on increased volume, unable to hold the highs and taking out the progress made or that tried to be made. That's just weakness. That's just sellers coming in now. Sellers have overcome demand. Okay, selling has overcome demand. Here, demand was overcoming supply or selling. Now it's just the opposite. Okay? And on bar 9, look, buyers couldn't even bring it up halfway into the previous bar before sellers came in and closed it. Again, it's a widespread down bar closing on its lows. It's a down bar because it's down below the previous close, and this one's closing on its lows on increased volume. Okay, everybody see that? Yes, this would be considered, George says, an upthrust. This would be considered an upthrust. Okay, and then on bar 10, we got a little oversold down here, and we see that we have an up bar, right, closing above the close of the previous. It's also closing on its highs, and it's also a widespread on high volume. So demand is trying to come back into the market, not surprisingly, because we saw demand or buying over here, and this is also a bit of support, or should be a bit of support. So potentially this is an opportunity for the market to heal itself and try to go higher. But this would be a widespread down bar, widespread up bar closing on its highs on heavy volume. And it signifies that buying is coming into the market. And that should be pretty clear. All right, how is that? Can we move on from here, or do we have questions? Okay, we can move on. Good. Why does the open not apply in Wyckoff analysis? Because it's just not useful. It just doesn't tell us anything. If we had opens here, in here, or in here, in here, in here, in here, in here, what does it tell us, really? It doesn't give us any information about what buyers or sellers are doing on that bar and how they close the day and who's in greater control, the buyers or the sellers. The open doesn't do anything for us. And what open are we going to talk about at this point? Are we talking about the open for these markets now that are pretty close to 24-hour markets? Are we talking about the open of the U.S. session? That's pretty U.S. centric, right? Or are we talking about the open of the Globex session? Those are two vastly different opens. Or are we talking about the open of the European session? You know, I think the open Wyckoff certainly understood that the market opened and that it could be charted that way and found it to be of little value. And I think now, 80 some odd years later, actually 100 years later, he first started writing in 1910, 100 years later, the open is even less useful. Think about that for you candlestick traders. Where is your open? What open are you talking about? You don't have an open. Anyway, I'll get off on the... Marilyn asked, do I care about gaps? Yeah, I do. We'll talk about those. There'll be some good examples of those coming up. All right, so let's take a look. Here's a stock. This is General Electric. It's a good little stock that we know, right? A big company, big Dow company. And let's just take a look at this. Look at bar, well, first of all, we're in a good uptrend, right? That's pretty clear. We can see that as we go up. Now look at bar A. We have certainly a widespread up bar closing on its highs on big volume. Should be demand, right? Somebody's buying in there. What do we see on B? What do we see on B? More volume than A. And look at the spread. Look at the close. Okay, what's that? What has that got to be? There's no follow through on the higher volume, says Scott, so it's got to be supply. Yeah, selling suddenly came in. And there was most likely selling on this bar as well. Okay? Selling came in here. Now, it doesn't take the market down. What happens next? We get these few bars here. And look at the spreads of these bars. Buyers are unable to take the market higher. They're closing poorly on these couple of bars. Then we dip down and try to rally up, but look at, that's this bar right here. That's this volume right here. Look at the lack of demand there. And then the next bar goes up a little bit higher. Don't see the big volume coming out. And then here we get a very kind of the same amount of volume, but narrow spread again. Okay? And then the next bar does have a gap open, indicating there's an imbalance between supply and demand. So we would note this. We would note that there is indeed, the market tries to rally higher here over the bars labeled C, and we just don't get any fuel in the tank to push this higher, okay, to push this market higher. Now, we spend this is a daily chart, so we spend a couple of weeks, we come down a little bit, nothing to write home about. But as we go up here and we revisit this same area, this is a test. Don't be, you VSA people, don't get confused. What we're doing is testing in here on this low volume. And we go up and bang. We can't go up any higher. Okay? This is a down bar with increased volume in an area where we saw supply come in earlier, then lack of demand come in, and now supply, now selling again. Okay, does everybody see this? Everyone see this? Okay, good. That's a perfect spot to take a short trade. Perfect spot to take a short trade. Why? Because we have an indication that sellers came into the market, demand has dried up, and now as we revisit that area, selling has come back into the market. Okay? It's not just because we have one bar here, it's the whole picture. That's the key idea here. Okay? So a short setup is the best idea on a test. When we have weakness in the background, weakness in terms of supply, no demand, and then a revisiting of that area, we're going to talk about this numerous times tonight. We come back into the same area and test that, and we see on this bar, no demand, and then this bar marked 1, supply. Okay? What are we testing on bar 1? We're testing for the presence of demand over here. We saw a lack of demand. They brought it back up to see if there's any demand left, if there's any more buyers left. Now, we want to also use good charting, okay? And we can, especially on an intraday chart, say an hourly chart or a 4-hour chart, you would have a nice little trend channel that's going up here, okay? Intraday trend channel. I just drew it here on the daily. It's a very good skill to develop to be able to see multiple time frames within the same chart. In other words, to be able to see that this is a little rally here on the intraday, and you can draw trend lines in, and you can see at the top of one we got overbought up here, and then it starts to come down. And we see big volume coming in. So If we were looking intraday on this, we might be taking a short trade up here if we were looking at this market for a trade. Okay. You can also drill down. We'll do a little bit of this on Saturday. You can also drill down into the lower time frame and see what's going on in here. We're going to talk about climactic action in a little bit. We might have seen some climactic action on, say, an hourly chart here or a 30-minute chart. And then that propelled the market down. Is bar 1 an upthrust? It is on an intraday basis. It would be upthrusting. I don't really want to talk about those kinds of things. It would be upthrusting the high here. If price were going to break through, what would the bars look like? We'll get to that, Bill. We'll get to that. If bar 1 had a high close, would that change the analysis? Yes, of course. Yes, good question, John. If bar 1 closed like this, if it closed up here, you wouldn't short that. I would then anticipate that this is going to at least come back up and retest this high. Okay? If we had a firm close, I would anticipate that we would at least retest the high, maybe come up here, and if it was still weak, then it might upthrust. This upthrust is nothing more than market going up above a previous resistance level and failing to follow through to the upside, and then instead closing underneath that resistance line right here. Okay, that would be called an upthrust. That also would be a very good short. But John, in that case, if it were a firm close here, you just sit on your hands and you be patient. Okay, you just sit on your hands and be patient. And trading is a lot about sitting on your hands. Okay, so what do we have at bar 2? We've got a widespread down bar closing on its lows with a big increase of volume, heavy volume, right? So no question, supply has entered the market. No question at all, supply has entered the market. When we see this, we would call this is a term from David Weiss, ease of movement. And because direction is down, we would say ease of movement down. The market moves freely and quickly to the downside. Okay? On this bar here that we talked about earlier, we would say ease of movement up, but it didn't last. Right? It didn't last. Now, I want you to note something that's very important. I'll say this numerous times. I hope I remember to say this numerous times. The difference between a high volume on this bar and the widespread, and the high volume and the widespread on this bar is very significant. This is occurring in a mature trend. We know it's mature because we've been going up for a while. This is just breaking down. Let's go to the next chart here. This is just breaking down out of a little trading range. Okay? High volume, when it's coming in as we break support, is if we're breaking support to the downside, it's very bearish. If we're breaking resistance to the upside, it's very bullish. Okay? So this is a key consideration. People talk about, oh, it's a high volume down bar, we should be buying. Not in this case, you shouldn't be buying. It's not climactic action. It's just coming out of a trading range. It's just breaking down. And it's supply is overcome demand, right? Remember that idea too? Selling is overcome demand, or supply has overcome demand. And we're breaking down. So we would expect more downside volume. Yeah, climactic. No, not yet. Not climactic, Marilyn, when it's just breaking out of a trading range. It can't be climactic at that point. Sometimes it might be, but that's very rare. Maybe less than 5% of the time that happens. That's not going to be the case. So you want to pay attention to this. We're going to go through this more times because I know it's a difficult concept to get. All right, what happens on bar 3? It's still a down bar, right? Because it's closing lower than the close of bar 2. But what happened? It's widespread, high volume still, closing above its middle. Well, why is that? Here, sellers were coming down through freely. And by the way, this, I forgot to mention that, this gap down, which makes this even stronger. This is just showing an imbalance between buyers and sellers, and the gap is happening in the right spot. It's happening at the beginning of a trend, not at the end of a trend. So this is what we would call a breakaway gap. I'm not going to write it out, but breakaway gap, okay, as opposed to an exhaustion gap, which we don't have one on this chart. We might have one here, but not likely, actually. No, this is not an exhaustion gap. But anyway, this is a breakaway gap. So when a gap occurs in the beginning of the trend, and we see good volume and follow through, that's a plus. Okay. Okay. So yeah, buyers are coming in on bar 3. Sellers pushed it all the way down, but then bang, buyers stepped in and closed it here. So this is what we would call potential stopping volume. Okay. Big volume, and now the close is trying to go opposite the direction of the current trend. And if we were looking at this on an intraday chart, we would see that it's probably very oversold to the downside. Okay, we'll look at instances of being oversold and overbought. Okay, but I wouldn't expect this to turn here and go up. Why is that? Well, number one, we're just breaking out of a trading range. Okay. Number two, we've broken down, this amount of movement from the high is quite a bit of damage done in this market. If you just go back and look at, all the days that it took to get up here, and we've erased that in 2 or 3 days. That's a lot of damage. Okay. So a market isn't going to recover real quickly. It's not going to turn around on a dime. In fact, most of the time, turning around on a dime probably happens probably less than 10% of the time. Intraday, it's a little different, but on a daily chart in particular, even on an intraday, you always have extra price bars to if you know how to read the price and volume, you have plenty of opportunity to get yourself out of a situation you don't want to be in. But I would not expect this market to turn here because of that, because a lot of damage being done. So what we see here then is a little bit of stopping volume, and then on the bars here at 4, we see light volume, and we do try to push down a little bit lower here, especially on this bar and on these couple of bars here, right? But look at the volume. The volume actually from this bar to A is declining. So there's, just like we saw earlier on the hypothetical chart where we were at the top of the market, or over here where we see no demand, this is no supply. It's just the opposite. We're seeing no supply coming in here. Okay. Sellers seem spent. The volume to the downside's dried up. And at A in particular, there's no downside volume. So we have to expect a rally. But again, probably not much of one. Okay? Probably not much of one. David says they couldn't push bar 3 much higher. And the reason they couldn't is because there's so much selling there. Okay? Now, why do I say it's probably not going to be much of a rally? Turns out that it wasn't, but one of the things that we will see over and over again is that markets come back into areas of supply, or if we were rallying up, areas of demand. Okay? And they will test them. And they're looking, well, there were buyers that stepped in here. Are there still buyers in this area here? Are there buyers in here? Okay. And that's what they're looking for. So on bar 5, we start a rally going up, and we see a little increase in volume. It's an up bar, average spread, closing firm. But what happens on bar 6? It shows there's no ability to push higher. Okay, we have a down bar, or you might think of it as a level bar, doesn't really matter which, but it's on sustained volume, a little bit higher volume than 5, but basically the same amount of volume. Well, how come we're not at least making the same amount of progress as we did on bar 5? Why? Which would be about a close somewhere up in here, right? But where are we? We're closing down on its lows. That's negative. That's selling coming in. Okay? Sellers have come in. And then bar 7, we go underneath the low of 6 and close up. Light volume. Sellers didn't step in, but it also suggests that there's no real buying there either. Okay? There's no real buying there. Then we rally up, push up to 8, and we see no demand. We see light volume. I know it's not less than the previous 2, but it's close enough for us. I mean, it's very light volume. We try to push up above 6, the high of 6. We do so, but the close is underneath the high of 6. It's on the intraday, it's an up thrust. Okay? There's no ability to rally. We come back into this area of supply, high supply, and we're trying to push through this kind of volume on declining volume. It's not going to happen. Okay? It's just not going to happen. You can short this bar on the close. If you wanted to, you could put a sell stop order in a tick or two below the low of this bar. Stop yourself in as it goes down. Doesn't really matter how you enter into this. If you were trading intraday and you caught the move here, you might, and you're fully cognizant of what's going on and you want to play for a bigger play, a bigger swing, then you might hold on to your trade. But clearly, there's just no ability to rally this because the supply is so dominant. Is there a rule for the area of supply on bar 3? No, not really. I mean, anywhere in here, truthfully, anywhere in here. And the lower it is, Edwin, the weaker, the lower the supply comes in, the weaker the market. Okay, the weaker the market. That's a good question, though. All right. Let's move forward here. So, with no supply, with no demand up here, bar 9, compared to 8 and 7, it's increasing, right? But it's basically an average spread bar. But look at the volume picks up here. And it's a down bar closing on its lows and taking out the low of 7 on increased volume. If you shorted here, you'd be happy with bar number 9. That's supply coming in. We see pretty sustained volume as we break the lows of A here. There was one attempt to try to rally back up by the buyers, but they just couldn't do it. And we just see this market sliding down. Look at the price bars where it's closing, right? It's down, down, down. We have one little up bar, but it's just closing in the middle. And then the next bar is down and down. And then we have bar 10. Could I explain the lower supply? Yeah. Well, what are you seeing here? We're seeing supply not as dominant as before. Okay? And this is typical with a trend, with a downtrend, Bill. When we break out of a trend, when we break out of a trading range, we expect the market to show us good volume. as it gets more mature, we expect that volume to start to lessen here. Okay. Now, what happens on bar 10? We have another widespread down bar on high volume again, right? What could that be? Anybody have a sense of what that might be? Climax, yeah, good, Scott. Good, absolutely. When we see a widespread bar after a trend is mature like this, and we can probably draw, I didn't draw trend channels in, but we probably could draw trend channels in, and well, that's probably unfair. It's probably more like about like this. We're getting close to being oversold, right? In this trend channel. So when we see a widespread down bar on high volume occur as a trend is mature, we have to be thinking climactic action, because this is a typical thing that we will see is climactic action here. And so we see on the next 3 bars, the bar between 10 and 11, fairly sustained volume. And again, just like we saw earlier on the hypothetical chart, we see the shortening of the thrust. We're not making any more progress down on pretty decent volume. And we're starting to hold firm in here. Okay? So if we were short from here or somewhere along in here, we'd get out of that trade now. We'd know that that buyers are likely stepping in, and we wait for further development. Okay. Sometimes we can draw several sloping lines on a chart. How do we know which sloping line to select for the real price channel? Try to keep it simple, Linda. Try not to have more than one channel. Maybe a higher time frame and then your immediate time frame. But if you got all kinds of lines all over the place, it's going to confuse you, as you're saying. Here we have a high up here, a lower high. So we would draw a downtrend channel, right? We would draw our channel down like that. In this case. All right, so now the next bar, let's go to the next. On bar 12, we gap open, not much volume. And the following bar here at A, we dip underneath, couldn't go below the low there and close it firm. Not much volume. What does that signify? Well, markets often do this. We often see the market, even all the way up to B here, not a lot of volume coming in. It's the holiday here. It's December 24th. Bar B is. So that's why you see the very low volume. But I would not expect much volume in there anyway. But markets often, when they've been damaged like this, they will often rise on light volume. We don't need to see the heavy volume coming in on a after a climactic move like this. Okay. We see on bar C, as we try to get above, we see bar C is narrow spread bar, basically level, closing on its highs, but we see a big increase in volume. What does that mean? Well, we're coming right into this resistance level, right? This was support before. It's now going to be resistance in here. And we're most likely seeing this just trying to absorb through whatever supply exists there. Hard to say what this is. This would be one of those bars where I would say, all right, it's closing firm, but the spread narrowed quite a bit, so it's the buyers are getting, somebody's in there probably selling, but it's a struggle. But the buyers are in there, they're trying to hold firm. We'll have to wait and see what happens in the next bar or two. You just wouldn't know. Let's see, if we were on bar 10 on the right side of the page, would this bar tell us watch out below also? No, David, because it's telling us that it's likely coming to an end because we're getting climactic here. We had average volume coming down, and then we see a pickup in volume in a mature trend on a widespread bar. Then the next couple of bars go nowhere. That tells us that this trend very likely is over. This downtrend is very likely over. Okay. So let's see what happens with this. Whoops, went too far. On bar D, we see one of those tests. It's a wild one for sure, but we had some supply coming in at C. The next bar couldn't hold, and we see the first down bar in this uptrend so far. So the next bar opened, came back into the high volume area here of 10, and the volume is less than half. And in fact, down here would have been early in the day, and I'll bet you the volume was probably down in here somewhere, very low. And it turned around and started to rally, and it rallied the rest of the day, well into the afternoon. That was testing of this higher volume bar. Almost all high volume gets tested. Not every single one, but just about all of them do. Okay, and in fact, we even come down again and test in here, test this widespread with this little bar. Okay, a little bit later. If I am looking into bar 11 or 12, if I am long into bar 11 or 12, how to avoid being stopped out if seeing bar sequences from C to D? Well, you know, it depends on what your play is. If your play is to look for a push up until you get supply coming in, this isn't supply. The only supply that we see here is C, but D says there's no supply, that there's only buying. So you'd want to keep your stop underneath this level. And, you know, a lot of times they'll come down and test a gap as well. But clearly, the high volume, you have to keep your stop underneath that, because it will. The odds are good that it will come down and be tested. If you're looking, you know, to pick up on the swing. All right, so we rally up, and look at what happens at bar F. We start to see higher volume come in, closes in the middle. Prior bar was closed in the middle too, but light volume, so a little difficult to read that. Suggested maybe lack of demand on the highs there, and a little bit of selling came in. But F shows that buyers pushed the market back up, but because of that mid-range close and the pickup in volume, it suggests that there was some selling coming in. And we would be very, very wary of this area because we're back over here into the area of high supply. Okay, we're back into the area of high supply. On bar G, we see sustained volume, above average volume in here, and the spread narrows. And then the next bar, H, is a down bar. It's closing in the middle. Some buying came in at the end of the day, but look at all that volume pushing this market down. Okay, there's still buyers there, but sellers were stronger. And they closed it down. And so here we've got weakness. I wouldn't short this in here. I wouldn't feel comfortable unless maybe I got in on an intraday trade and I was pretty confident that this wanted to go down. But I certainly would be, because there's nothing really clear here to short in my judgment. But I would be wary. If I were long from down in here somewhere, then I would cover the longs, exit the longs rather. And then I shows us good volume coming down as well. Okay. Well, I can see we're going to go over time. This is still the first chart. I've got 50 of them. All right, let me go a little quicker here and try to pick up the pace a bit, so that we can cover some stuff here. We're coming down, but we're not getting very far down. Okay, we're not making a lot of progress down. So we see big volume, the same level of volume as on H and I at J, and we see an attempt to try to hold the market. Okay, and if this was a serious climax over here, we'd be thinking at this point, then maybe the market will hold somewhere in this area. In other words, if buyers were coming in and trying to push this market, trying to hold this market at this point, then we would expect this area to be another spot where buyers would come back in and defend. Okay, why would I say that maybe this is a strong area of buying? Well, because look at this big move up that we had. Okay, it's bigger than the last down move, and certainly bigger than the last little up move that was unable to rally. Okay, in terms of distance covered and time covered as well. So there was more time and more distance spent on this up wave. So there was more buying. In other words, there was more demand. Sellers weren't able to just knock it down right in here where you would expect them to. You would anticipate this would be a spot of difficulty because this is where we had resistance before. But they weren't able to do it. In fact, it was pretty easy to push the buyers to push that right on up. So, you have to kind of think that through a little bit. This stuff, by the way, I should say this too. This stuff isn't easy to do. It's not that it's really hard. It just takes a long time and a lot of charts to see, before you get good at this. It probably takes a couple of years before you really, and I think trading just in general takes a couple of years before you can get good at it. So you want to be able to, you want to take your time and spend a lot of time practicing this stuff. All right, so J, we see evidence of demand come in. K, and certainly L, well, forget L for the moment. K, we see, an inability, we're trying to hold around the low of J. On the bar after K, we see that light volume coming in to the downside. And how come, you have to ask yourself, okay, we're starting off here and making good progress down, and it's on this volume. And we're not making any more progress, and look at the volume. We don't have supply anymore. Supply is dried up to the downside. And if we look at this, we make good progress to here, but then look at the lack of progress going down. So we're seeing shortening of the thrust in here again. And L is an obvious bar of strength, an obvious buying here. They gap it up the next day, and then they pull it back down, and they come back into the widespread higher volume level again, and then take it on up once more. Okay, so M is another test. They're always testing. They're always testing the market. Is L a spring? It's an intraday spring of the previous two lows, but I wouldn't call it a good spring. Stop it, Asta. There's nobody out there. There's no one out there. No, it's too cold. So when we look at this now, and this market went substantially higher than this, but over between from the early November here, or say mid-November, into the first of the year, there was a zone of buying. This is accumulation, what we would call accumulation. Okay, and it could have extended maybe as early as stop it. That's enough. Maybe. All right, excuse me a second. Let me put him in the other room. Come on, come with me. Let's go. Hurry up. Sorry about that. We're alone here, so he's kind of on guard. So here we can see that from M all the way over to 10, and maybe as early as 3 here, we see a zone of buying. So we would take a point and figure chart, start it here and calculate. I'm not going to do that tonight, but you'd calculate it here and then you'd expand it upwards and you would get projections for that. But this is a classic accumulation zone complete with testing all across months, weeks and weeks of trading. So we can see a lot in one chart. We see low demand at the top. We see supply overcoming demand and ease of movement down with high volume out of a trading range. We see inability to rally. We see stopping volume. We see climactic action, a low volume rally off of that climactic action, weakness at previous supply, and then buying in to stop a down move. All right, any questions on this? He keeps the deer out of the house. I'd like to keep him out of the house at times. Would I go long at M, and how would I know? That bar is a particularly difficult one to buy in on. I like bars like J. If J occurred at M, I'd have no qualms about getting in there. This one, I would probably look to buy stop in here you've come into a very narrow range in here, and I see volume starting to pick up here. So I'd look to probably buy stop my way in on this bar, assuming if I'm assuming I'd read this properly, and I would want to see this market start to take off, which is exactly what it does. Sometimes you'll see tests like that, but this to me would be hard to buy. If it looked like J, if M looked like J, I'd have no problem. But that's a little too. It tried to go up, it tried to go down, and it closed in the middle. And so within a few bars, it should resolve itself. And I would be thinking about, I'll take a resolution a little bit later. Where's the stopping volume on this chart? Bar 3 is stopping volume, and really bar J is a minor stopping volume, but 3 is a clear stopping volume. Is the accumulation zone just along the support line? Well, they were buying between probably 20.5 and 21 is what it looks like to me in here. Maybe 21.5 to 20.5 in this area. It would be a little more clear if we constructed a point and figure chart. What's the clue that accumulation is occurring? Good question. So I see climactic action, I see buying, I see buying, I see buying, and I see liftoff. That's what's telling me that this is accumulation. Okay. We're going to look at a couple of more examples of accumulation. Is stopping volume always before climactic action, and do you always have both? No, not always. This would be, in Wyckoff terminology, maybe some preliminary demand coming in. Is the clustering of bars after M considered absorption? No, just kind of, just kind of in a being held. They're not ready to mark it up for whatever reason. Maybe there's no news yet. Maybe the news came out this day or this day. I don't know if there even was any news. But this is more of what they call an apex or a hinge. It's ready to go, but it's not quite ready to go. Oh, Helen's home, so that's good. All right, so let's move on. Oh boy, I've only gotten through one chart. I'm in trouble. Wasn't sure I'd have enough to talk about. Well, we can certainly see, this is always the problem with me, is that I can talk about these things until the cows come home. All right. Same principles on a higher time frame. This is Pfizer on a weekly chart. What do we have at A? Stopping volume over a couple of bars. We're coming down strong, but look at the volume come in even bigger here, and look at the firm close, and that only buying can do that after you've got this much selling coming in. Now, on an intraday basis, this would be climactic action. You know, if we were looking at this on a 4-hour or an hourly chart, this would have, you know, you'd have your trend line like this, and it would be way oversold and climactic. But that would be on an hourly or a 4-hour intraday chart. We rally up to B, we come back into the supply level, we push pretty far into it, okay? But look at the volume. It's not going to get through that on that kind of volume. And so we come down here to C, and we see volume is light, suggesting that this is testing action coming in here. We're you know, less than half the volume that we see on A. As we come back in that area, well, market isn't going to push through an area like that. And then the next day we do get this on a daily chart. This would be a nice spring right here on D, and we get volume off the bottom, and ease of movement up, right? Ease of movement up. And this has to tell you that buyers are in control. And A, therefore, has been successful in stopping the market. So, once again, let me just point something out to you, that very few turns in the market occur on 1 or 2 bars. It takes a process. It's always a process. So being able to do bar by bar analysis effectively means you understand too what's going on in the background. And so here we have stopping volume. Now we come down and volume to the downside's drying up. Then we get buying coming in. Well, that has to be good. Okay, that has to be good for the buyers. So we look for a trigger. We look for indications to trigger a trade based on these prices and these bars. Okay. So we push up, and look at the volume picks up as we rally, and we're breaking up above this heavy supply bar. And in fact, we're coming into, if this was, you know, resistance here for us now, we're able to break through that, and we're able to push through that. I don't know why this says E here. Sorry, that's a mistake. Let's call it E1. We try to rally up a little bit higher. We can see that the closes are not making big progress. We see the high to high relationship isn't making big progress, and suddenly the volume is dried up. So we're expecting a pullback, and we get that down to F. I must have been, oh, I'm sorry. E was right. I just had 2 E's in here. I really messed that up. Sorry, that's not F. So this is E, and then this is E1. Okay, and then this is E1. So we come down and look at the light volume. There we're having a test of this area, this high volume area, okay, on a weekly basis. That's strong stuff. And we would drill down into a daily chart and look at this, and we would be able to see good relationships here on the daily with an opportunity to buy, probably on Friday, which is when it usually happens. And then we drive up, look at the widespread ease of movement up here. This is all ease of movement. I know that this is not quite as wide as before, but it's still pretty good, and we're seeing volume coming into the upside as we move up. And again, we come up to the top here, look at the volume dries up a bit. We start to see a little supply coming in, but then that dries up, okay? So we can continue to see these same kinds of things on all kinds of different time frames. Here's a 5-minute chart. We can see this is the S&Ps. Same principles occur on the intraday. Same kinds of stuff. Light demand coming up here, narrow spread bars closing up and down and not really strong ease of movement. Suddenly at A, the market opens in the US. We get big volume coming in. We get a strong down bar. Well, that's supply. And we're off to the races. And we've got ease of movement down. Okay. We have a little bit of stopping volume coming in here at B. Over the next couple of bars, really. So I would say B through C. There's, you know, it's trying to hold in here. But once again, you can see that it's trying to hold by the virtue of the fact that the closes are all basically in the same general area, maybe 3/4 of a point from one another. Just not able to go down any lower. Okay, and certainly at C, we see volume pick up and the market hold in here. Okay, the market's really trying to hold in here. So D starts the rally off. And then the question is, can we get through supply from earlier? Remember, we talked about this before. Can we get through that supply? Not on that kind of low volume, we can't. As we're going up, volume's coming down. And look at, we just go sideways here for a few bars. Again, we're seeing the closes are all basically the same. There's no ability for this market to push up. Buyers are basically remove themselves. There's just no bids in the market to push the market up. No selling, no serious selling in here, but no bids either. And then E, a low volume, but we see that it went up above the previous couple of bars and then closes down. This is, if you were trading this intraday, this would be a perfect place to short this market. Absolutely good spot to short. Okay. On F, what happens here? We get widespread down bar, big volume. Is that climactic action? No. Why? Because we're breaking down below this trading range, this support level here. We're breaking it on good volume. That's what we want to see. Okay, that's exactly what we want to see. And then on G, what happens? We get the biggest volume on the chart of this morning session. And so we we get that widespread bar, and it's far away from where the trend started. So we want to be aware that we could be seeing some climactic action, or at least some stopping volume in here. And we can see, I just put these green arrows in, there's clear evidence of attempts to buy in this area. Plus, we're near the noon hour. This is 12 o'clock Eastern time, New York time, which is when we have a good move down like this, we'll often see a counter trend move occur over the noon hour. And then if it's a true trend day down, we'll see the afternoon be trending as well. And so G is the beginnings of a climax. Climaxes can occur on one bar, or they can occur on a couple of bars. So we would expect that to be, and climaxes can be minor or they can be major climaxes. So we would at least anticipate this being a minor climax. All right. Where would we take a trade here? The best place to take a trade would be at E. I mean, I would be looking at anywhere in here from D to E to take a trade, because it doesn't really matter where you buy or initiate the trade, because, well, two trades really. first trade is on A. I mean, that's a picture perfect trade to make. You got weak rally on no volume, and suddenly supply comes in. That's a nice little trade to make. And then anywhere between D and E is fine, because all of this supply, you can see it, we're in that same area of supply, and the volume is drying up to the downside. It's not gonna be able to rally through that. And look, in other words, forget the volume even. You got widespread down bars, ease of movement down. Do these bars here look like they can take these guys on and beat them? No, they can't. They're narrower spread. Compared to these widespread bars, these are narrow spread bars in here. So remember, spread relates to activity. There was strong activity to the downside here, strong selling activity. This is weak activity to the upside. It will resolve itself down. So anywhere in here is fine to short. Okay. If you sold D or E, where would you put your stop? Well, with S&P trading, what I like to do is you want to keep your stop. I'll do a quick thing on this. In a situation like this, I have a money stop. Okay, in other words, I have a certain amount of money that I will not make a wider stop on, and that should really be between 1 to 2% of your account size. So just to keep things simple, let's say you got a $10,000 account. Okay, so that means 1% would be 100, and 2% would be 200. Okay, for a stop. So if you split it down the middle at 1.5%, then that's 150. Okay, so that's 3 points in the S&Ps. And that's generally, unless the volatility is stronger than average, that's generally a good stop for yourself. So if you stopped in here, which was around 26, say, then your stop would be at 29 up in here. And that's fine. Okay? You got plenty of room. Very unlikely it's going to go up in here. Another way to think about placing a stop is you've got some kind of support level here, and this market, this was support, and now it's having difficulty it broke down through that nicely on the big volume, so it's unlikely it's going to get up above that. So you want to just place it somewhere up above here, your stop. Okay. But for me, what I do is I just 1.5, 2%, and it's just an automatic stop, and then I'll adjust it as the market unfolds. It's typically what I do. So 10,000 per contract is good money management. Yeah, that's a standard in the S&Ps. Other markets might be different, but that's a very standard thing. 10,000, and if you started off just looking at trying to make 4 points, 3 to 4 points a day on average in the S&Ps, and you started off, I mean, I've done this numerous times and seen other traders do this. You start off with just 10,000, you'll be up well into the six figures in 7 or 8, 9 months. You should be if you're trading well. Is A or B a climactic bar? Not really. No, not really. A is just pushing down out of a trading range, or pushing it down out of a weak kind of rally. So if price chugs along and volume becomes lighter at DE, you assume it's not going to take out the downward push started at B. Robert, what I'm assuming is that we have supply over here, and that there were a lot of sellers in the market, and that there's also a lot of people standing on the sideline and wishing they got in here because the market's come down. So if the market goes back up in here, I'm sure that sideline traders will step in and sell this short. I'm also sure that that larger players would see any rally up and say, oh, thank my lucky stars, I can get even more contracts under my belt and short even more. And then there are going to be people who thought this was a good spot to buy because, this was a good spot to buy in here because it's support. And now we're back up into this area, and they're long, and they need to get out of their trade, so they've got to sell, and they're putting additional pressure on the market. So for all those reasons, I would anticipate this to be selling in here. Okay, so if you did have a structural stop area somewhat closely corresponding to your 1 to 2% money stop, would you take the trade or wait for a closer alignment? If I did not have a structural stop, depends. It depends on what I thought the market was going to do, but probably would take it. If I was, if I'm in tune with the market and I'm reading it well, and I feel pretty good, if I feel like I understand what's going on, and I don't have if I don't see a good stop, then I don't mind just taking a money stop and playing. And sometimes I'll get stopped out of that, and that's okay. That happened the other day. I was trading, and I thought I saw some climactic action, so I went into the market, and the market kind of went sideways and then drifted down for about 2 points, and I actually bought more, and didn't let it get stopped out, and then the market started to rally from there. So yeah, a lot of times I'll do that kind of stuff. If I'm trying to buy, like if for some reason I thought G was a good spot to buy, because it's coming down hard, I would probably go in light. In other words, I wouldn't put multiple contracts on. I'd just put a couple, and then see how the market unfolds, and then maybe over in here somewhere I'd add more, feeling more confident that this is going to hold, because it's hard to say that, okay, it's going to stop right here. This could come down another 3 or 4 points from here. Sometimes that happens. So in doing that, I would want to go in lighter in terms of position size, not take a full position on something like that. But try to get in and then build a position. Sellers are always going lower, looking for buyers. That's right, Marilyn. Can you explain bar after D and relate it with bar B? The bar after D. Well, the bar after D just tries to go up and has light volume. It's just really showing that there's a lack of demand. And relating it to bar B is that there's supply on B, a lot of supply. And so it just is indicating that there's no demand in an area of supply. And so it's going to resolve itself to the downside. We're going to see more selling. Next chart, yeah, okay. Let's take a quick look at the Weiss wave. I only want to do this briefly. This is the same chart. Now, that was a 5-minute chart. This is a tick chart, and with tick charts you can compress the overnight data nicely, and you can see that this was, I think this was yesterday's high, and so we actually up-thrusted yesterday's high. So knowing that, back here, if we go back, knowing that this is occurring here against yesterday's high is very nice. And what we use the Weiss wave for, a number of different things, and I'll talk more about it on Saturday, but one of the things is that it tracks the waves in the market. And I'm not going to go into details about how it's constructed and all of that at this point, but it's tracking the waves. So you can see a down wave here, and also the volume on that wave. It's adding up the volume. Well, we can see that there is very light volume on this rally up to A, and we saw that on the bar chart too. And then big volume coming down on this wave, and then look at the rally up to E here. This is the same area of E as before. Look at the volume. The waves are small. There's not much ease of movement. Here there's ease of movement, right? In terms of the wave. And here, on this up move, there's no ease of movement. And so you can short this bar, or you can short this bar. Either one in here. Perfect shorts. Perfect shorts in this market, and you're backed up by very low volume. So we can use volume not just on price bars, but we can also put them in terms of waves. Now, the waves, this is David Weiss's rendition of Wyckoff's original wave chart. Wyckoff originally tracked 5 or 6 different stocks and made a wave chart by hand from that, and then had a point and figure chart where he also tracked the volume. And what David did was basically combined Wyckoff's wave chart with his point and figure chart with volume and made it into what he calls the Weiss wave. It's a superb, especially for the intraday, it's a superb trading tool. The best thing that I know of in terms of a trading tool. This is, well, when I first got it from him back in 2006, I think it was, and I played with it for like about a week, and the next week I saw him, I said, David, this is like a license to steal. This is incredible. And he kept it under wraps. He only gave it out to maybe, I don't know, a dozen people. And now it's, of course, it's widely available. You can buy it from him on his website. You can buy it from me on my website. We just host it on our website for him. It's David's. It's not mine. I've used it forever, or for a good number of years anyway, and it's a really good tool. But you can learn more about it on our site. All right. Will I be talking about the 310? No, I won't, Gordon. Not in this. Not in this. Okay, so let's go forward here a little bit more. Let's take a look at a currency market. Okay. So we can see that the rally prior to A doesn't seem to have much strength. But this was also over the holiday period, right? So you have to kind of take that in with a grain of salt. But if we look closely, price bars were closing strong, right? Pretty strong in here, all the way up to A. And they were showing, some ease of movement up. It wasn't easy to move the market down, but it was fairly easy to move the market up. The reaction bars here just weren't strong. Okay. Then pushing up through the resistance on A, we see an increase in volume. That's what we want to see. I would have liked to have seen wider spread here, but at least we got the volume. And then on B, we get high volume, good move up, but then the negative is a pretty big one, and that is that it closes in the middle. Okay, for this kind of volume, we should see this market close firm if it's going to continue to go higher, especially when it breaks out of a previous resistance area. And if we go back to that resistance area, look at what we saw. We saw a big volume come in and a poor close. The market then holds, and now we come back up into that area. We get up above it, but suddenly we get more supply again, and also we're not getting quite as much volume as we saw up in here before. So there's not as much demand that can match the supply. Okay. So we react down, and we see that buyers step in. They're stepping in, they're buying that support level. If we extended this over, it'd be pretty clear that they're buying off of that support level. And we see, oh yeah, let me, I forget to move this forward. So they're buying at C and again at D. And there's a little more volume at D, which is a plus. And then what do you think E is? What's happening at E here? No supply, right, Linda, exactly right. This is picture perfect no supply. We're coming back in testing D now, if you will, right? We're testing, we see some pickup in volume at D. We come back in and test it. So what we expect now is this, that we're all set for a rally, and that's what happens. And volume increases. I'm sure I got this. Yeah, okay. So volume increases, and we push up to 1, and we get good volume, but look at the close. That should not be if this is going to go higher. We're coming into the supply now that we found at B over here, and a few things are happening. First, less volume. Second, sellers are stepping in. We rallies up to the high there, comes above this local high here, but then fails to go higher, and sellers step in on that. The next bar, 2, goes up, okay, but look at the volume, not very good. Bar 3, we get more volume coming in, again, not as much as B. What happens? The spread narrows a little bit, and we can't close over the top. And at 4, we see no demand up there. We try to rally up, and in fact, there's probably a little tiny upthrust, and then the market comes down. Okay, so when we are breaking above a resistance level, we want to see strong volume and firm closes, just like we saw in the other markets there when we were breaking down below trading ranges. Here we're breaking up above a trading range. We need to see the same thing in the opposite, but we're not seeing that. And at the end here, we come up, this is really kind of testing B, and we're seeing lack of demand and no ability to rally up here. Okay, so we can, how would you play this? You could short bar 4 certainly, or another way to play this, one of the ways that I kind of like is to, put a sell stop rather underneath, I keep doing that, underneath the low of bar 4, a tick or 2 below it, and then allow yourself to be stopped into the market. And that's a way to do it. Okay. All right. Here's a variation on the same kind of theme. This is back with the S&Ps again. And here we have, this is something I'm always watching in the S&Ps, is yesterday's highs and yesterday's lows. Very cognizant of those. Here we're up near not just yesterday's high, but we go back 2 days. It's a very similar high. So we're at the same level. Now, rallying up, we push up in here on wave A, and it has nice volume going up. That's pretty good. We pull back a little bit. We kind of hang just underneath the highs from yesterday and the day before, and then we push up again, but look at the volume. That's a negative. And then we come down here, and we have increased volume to the downside. Look at how this wave volume is bigger than anything all day long. And except for the close yesterday, it was bigger than all yesterday afternoon. So suddenly supply has made its way. So this could be a potential upthrust. Okay, we look now to, and as long as this volume stays relatively modest and doesn't get bigger than this volume here, we'd be looking for an opportunity to short in here. We would look to the price bars to give us that opportunity. Okay, and we can see, this might be a little hard to see. We get that down bar right there. It's kind of hard to see because these are compressed bars, but we tried to rally up and then couldn't hold it, so we would short that. Didn't get much out of it. If we place our trend line in here, we would, and you can see there are several bars in here that are trying to hold, so we would cover that. So it didn't work all that great, but there was certainly a downside move here. There was maybe 3 to 4 points out of this, but you know, as I said, if you just focus on trying to get 3 or 4 points a day, you've made your trade for the day, and you can be done for the day. But again, it's looking at the volume relationships where we would expect. I mean, one of the themes that I'm trying to convey to you tonight, where traders get hung up all the time, is that on breakouts, what we want to see is good, strong volume. Here's just another currency chart. Here's the Swiss franc. Look at A and B here. We try to rally up at A, and then we get swamped, and this is B's volume here, and B closes down in here and continues to go lower. Now we come back up to revisit, and it looks like there's ease of movement coming up, right? But look at what happens. The volume here is substantially less, and we close back underneath the high of, I guess it's this point here. And then we come down, and then again a weak rally up, and then come down lower. This again is an up thrust. We want to see firm closes and pushing up. Okay? So if you're buying this breakout and it does this, you want to immediately exit your trade. Okay. Same thing here. No, not much different. Look at the supply look at the climactic action that occurs here. Right, this huge spread up. This is copper, and we close here, and we just go sideways. We try to rally back up into this area. Look at the price bars. Look at B. We pop up above the high of A and then close below it on volume. Then C tries to go back up above, and look at the volume. It's no demand up there. So on the next bar that comes down, there's your short right in here. That was a nice trade. Okay. So here's a chart. Here's JP Morgan on a daily chart. Let's kind of talk this through. What's likely to happen here? What do you think is likely to happen here? Will this hold around 45, 44 and then go higher, or are we looking into some supply here and go down? So George and Gordon and Paul say it's going to go down. Oh yeah, everybody's saying that. Good. You guys are all seeing this, that it's going to go down. So let's take a look at this. There's some things to learn from this chart. First of all, we can put a trend channel in here. It's not the easiest trend channel to draw, I guess, because there's not a lot of touch points. This is about as good as I could kind of figure here. Second thing to notice is we get oversold, or I'm sorry, overbought up here. Overbought. When we get to the top of a trend channel, we're overbought. So we would be overbought here. And we'd be oversold down in here and down in here. When it comes oversold, we expect it to go higher. When it becomes overbought, we look to see if it will go lower. Okay? So, look at the volume, something we haven't talked about. But here we are, we've been going up all this way, all this time, and we see that volume is kind of going down, but it's certainly going down here, but it's certainly the last, here the average is down in here, but if we just look at these last few bars here, the average is probably somewhere in here. Quite a bit more than most of, than the average volume for most of this trend, which started down in this area. And you can see there was high volume down in here. This is typical of a market, of a freely traded market, that towards the end and at the end of a trend, you will see the volume swell. And that's what we're seeing here. Okay? We're seeing the volume swell. It's an important thing to note. Now, let's talk about some of the price bars. Look at A. We have that big gap up. We talked about a breakaway gap before. Well, when a gap occurs like this at the end into an overbought position in the trend channel, when the trend is mature, the odds favor that is an exhaustion gap. Okay? And that's exactly what we see here is an exhaustion gap. Now, another little trick that you can do is to take the true range of the bars. Everybody know what the true range is? It's the difference between when you have a gap like this, we would say that the range, the actual true range of the bar is from the close of the prior bar on up. Okay, so if we drew an imaginary line like that in there, suddenly what do we have? What does the spread look like? It's a widespread bar, right? So we have a widespread bar, up bar, on pretty close to the biggest volume since the trend began several months ago, or a couple of months ago. So we have a widespread up bar going into the top of a trend channel on big volume. What's that suggest? What's the cautionary note there? We want to be aware of climactic action. Okay? Does everybody see this? I want to make sure you all see this. This is important. We can use true range when it gaps like that, and we can just use that sort of little shorthand to kind of, that visual help to understand what the bar really is doing. And that's what we see here is climactic action, or potential climactic action. The next bar, B, still pretty good volume, but much less than A, and the spread narrows. So suddenly demand dried up there. And then C, what do we see here at C? We see certainly a widespread down bar closing on its lows on massive volume, right? Huge volume. But let's back off a second here. Do we see, this is a critical chart for this. Do we see any down bar since the uptrend began down here? Do we see any down bar that's as big and on as big a volume as we see here? And the answer is no, right? This is what we call a change of behavior. This is what Wyckoff would call a change in behavior. This is selling coming in spades. It's supply over demand. This is one of the things we look for all the time. When we're in an uptrend and suddenly we get a large down bar on substantial volume, and it's the biggest down bar that we've seen since the rally started, then we know that behavior is changing, because the behavior hasn't been that way before. Look at the behavior before. Well, we had one down bar here that was pretty good, right? Look at these, hardly anything. Look at these folks in here, very little, very little, very little. Massive, huge, ginormous, as the kids say, right? You got a ginormous down bar on ginormous volume. That's a change in behavior. Change of behavior. It's very logical, okay? It means that this uptrend is over, and now we want to look for an opportunity to short. And so what happens? We go back into that selling, back into the selling range of bar C. And what do we have? D is no demand, and the question mark bar tries to rally up above D, fails to hold, and then comes down, and volume picks up a little bit. That's supply. I'd have no problem shorting that. Just short it and put your stop. You'd be shorting at 45 and, I don't know, 20 cents maybe, and you put your stop at 46 and 80, you know? You got a $1.50 stop. It's nothing for that kind of a stock. And you adjust your position size accordingly. Okay? So here's where we were, just to kind of highlight what a change in behavior can actually do. And that's what happened with this. And we would have had, you know, quite a bit of selling in here, quite a bit of supply. And the market just chugs its way down. That just happened on the NQ a few minutes ago. Yeah, maybe. I haven't seen that. Okay. What's this? Oh, yesterday's S&Ps. This was kind of interesting. I put this on kind of as a last chart here. Some interesting things that occurred. Again, we see very similar things over and over again when the markets heat up and are really good for trading. Today in the S&Ps was a crummy day to trade. It wasn't even worth it. After the first hour and a half, 2 hours, that you could tell that there was a range. It was a range-bound day. You don't try to trade that. You come back in later on in the afternoon, see if maybe there was an afternoon rally. The S&Ps tend to get trendy in the afternoon, but again, there wasn't. It was just range-bound. So we see once again, this is yesterday, we see once again the markets pushing up, fairly light volume in here. We get churning action coming in. It's pumping up and down here at B. We try to rally up. We get pretty good volume coming in. I didn't label these as well as I probably should have. I think that's this bar. And then 3 bars later is, not that one, this one is here. Yeah. So we try a couple of times to go up on high volume off of the open, and we fail to do so. And we come down here to C. This would be a little bit hard to take a trade on, but we break down, and exactly what we want to see, the high volume coming in on the break. Okay, the high volume comes in on the break. And I hope everybody can see that there's a bit of a trading range in here that we break out of. A lot of churning in here that we break out of. We come down, we get, market tries to hold. You can see it trying to hold in here. We get just a very weak rally. Look at that, no demand on E here. And you can see, and we get a tiny little upthrust here, there, as it's coming down you would short, or you could put your stop in under here to stop yourself to come in. But once again, we get the high volume in a mature downtrend. We've gone from whatever this is, maybe 45 down to 30, so that's 15 points. That's a pretty good move in an hour and a half in the S&Ps. And we see the highest volume coming in. We have to be aware that this might be indeed a climactic action, a selling climax in here. And we want to be aware of that. And we can draw in a trend channel and we can see, by goodness, we're oversold here. And so we want to be aware that this trend is most likely over. Then we rally up. There's not much on the rally. We know that. We come back down, but look at what happens. The volume just dries up. And we get down to G, which is a spring, and we're half the volume that we were at F. So we would be buying this, trying to buy it. And we get a nice push off here. It's kind of a little bit of a nebulous kind of a trading in here over the noon hour. And again, I didn't realize this, but I said before, the noon hour is often a point of inflection in the S&Ps, and you certainly see that here. And then what happens? Look at A. Look at A here. What happens? We get the high volume, widespread bar, after the trend has been going since, what are we down here at 28, and we're up to 35, maybe whatever, however many points that is. And at B, bar B, the spread narrows, the volume picks up. We know that there's going to be, that's probably the end of the trend. And it tries to go up there again at C, and look at the volume picks up. These are little it's a minor climax there. We were looking at this on, say, a 1-minute chart or some sort of a tick chart, you would see that. And I don't advocate going down to a 1-minute chart. That's foolish. Don't do that. People do it. Some people are good at trading that. I think that's crazy, personally. I think the minimum is a 5-minute chart. Does climactic bar have to have the highest volume? Not necessarily. I think we've seen one or two that didn't. But typically what we want to see is we want to see that wide spread coming in, Linda, at the end, not at the end, but where we're oversold or overbought, and certainly after we've broken out of, after the trend's been going for a while, okay? And, you know, if you're trading, and I would suggest you do this, you trade one or two markets and you get to know them. And, you know, like, for example, the S&Ps, I've been trading this since 1999, and I know that a 15-point move is, you know, a 10-point move is generally pretty good, and anywhere above that is, this is probably more than 15 points, but it's a very strong move, and the markets can't sustain much more than that unless we're in. You know, there was a time where we were getting 80 and 90-point days. The volatility was incredibly high, and the trading was incredibly good. But there'll be days that happens, but those tend to come in periods, and we won't see that again for a bit anyway. The volatility ebbs and flows a little bit more regular than price does. It's a little more predictable than price. So we're not in one of those high volatility periods now. Towards the end of the chart, spiking volume but range bound. Given context of rally slowing, would you look at the chart turning down? No, not in this case, David, because this was a lot of damage that was made, but we've recovered quite a bit, and now we're holding gains in here. So I'd be, you know, looking for a push up, probably to retest these highs up in here. I mean, I have to look at the daily chart to see too, but that would be my sense of it. All right, let's take a look at, I wanted to talk a little bit more about accumulation, because this is something that I see a lot. We see it some, you know, in the intraday charts, but here, big charts, here, weekly chart. Here's ExxonMobil, and this is actually the live, or maybe a week or two ago. But somebody was asking me, how do you tell that accumulation is really happening? Well, look at this. You know, we've come down to A, and we hold here. We come back down to the level of A, and we immediately pop up. And we come back down again at C, and we pop up, a little more volume this time. And we come back down here at D, and then we start to rise up. And then we break above the trading range on 1, and we're getting that good volume and the good follow through here. So this is a market to watch. We'll see what happens over the next few weeks. Comes back down, maybe comes closer into this area. Looks like around 95 or 96. This could be a nice little buy opportunity in here if it acts right coming down. But this is accumulation in here. Every time it was dipped down to this roughly 85 level, 86 level, whatever, somebody was in there buying, and they held the market up. And we can't really talk in detail about accumulation. Here's Google on a weekly basis, right? And there's accumulation zones in here too, technically reaccumulation zones. We see one down here, lower down. We came down, light volume. We come back down at 2, volume picks up. How come it didn't go down? Why is it holding in here? We come back down to 3, fairly light volume. And then we rally up, and we push up, we break up above, and we have nice volume picking up, just exactly what we want to see on the breakout, right? Then we come back in and test. This is what I'm talking about for Exxon. Maybe we'll do something like that. Come back down and test, and we push up here. Then look at here, this beautiful accumulation ended on a spring right here at C. We come down to A, and then B, and then C, and then look at what we get here on D. That beautiful drive up. Boy, that's picture perfect. We're heading up, probably up past 1200. Do a point and figure chart. on this. This happens all the time. I mean, there's Google and Pfizer and Exxon that we've seen. Here's one. This is today, 15-minute crude. Okay. Look at what happens. This is yesterday's high. It's not on the chart because it's just to have a 15-minute chart on it. I don't have a tick chart here, so I want to show you this on the price action. But again, we're not getting. We came up to yesterday's high, and we've just been playing around it, and it seems like right around, I don't know, what is this, 95.30 level, that there's buying going on in here. Okay. You would think that if price, for example, if price couldn't get up above yesterday's high here, then it would continue to go down. Or if it went up above yesterday's high and then came back down, it would continue to go down through. But it didn't do that. It didn't do that at all. It's just holding and holding and holding. And then we get the breakout here on C. And what do we look for? Good volume, widespread. We get that nicely. And then it comes back in and tests at D. And either D or the next bar was the buy point. And then it rallied, and I think it went up even higher. I didn't watch it all through the rest of the day. But those accumulation areas are something not to get super focused on them, but when they're happening, when they're holding gains like this, like go back to the Google chart for a second. When a market, especially like this, I mean, this was just so obvious, the second one in here, we're making, you know, we've got a high and a low and a higher high and a higher low. This is my definition of an uptrend, right? Higher high, low, higher high, and then we just go sideways. We're holding gains in here. Okay, they're not letting it go down. For some reason, at this level, whatever this was, 850 or so, they wanted this stock. They being the larger players in the market. They wanted that stock. And it's our job to try to read their footprints, so to speak. And this was pretty, you know, so let me just say a couple of things here. Seeing this, you know, I've told you about it, you've seen it, you've seen a couple of examples, that's pretty cool. But I guarantee you that if you saw this now real time on some stock or some market, whether it's intraday or a weekly like this, you probably would have a lot of doubts. Well, is it really going to work out the way Gary says, you know? Well, don't take my word for it. What you really want to do is you want to go back through the charts and you want to find other examples of this. You want to study this. And the same thing on the breakouts from the trading ranges. Study and see. What I'm telling you is, you know, see if you can verify that for yourself. The more you see them, right, the more you see the accumulation zones holding like this, and you get, you know, dozens and dozens of charts like this, then you're going to be confident. And you can say to yourself, okay, you might even say, you know, most of the time it comes down 1, 2, and 3, and then it goes. So, but even sometimes it only goes 2 times. But even if I bought it here, it wouldn't be a big deal if it comes down a 3rd time, because it just comes down to that level. So, you know, you get to know this a little bit, this kind of a trade setup for yourself, if you study charts and look at numerous examples of them. And doing that, then you get confident in them and you know how they're supposed to act. You've got a range of behavior that you would expect. I can't go through all the different kinds of behaviors and variations that go on here. It would take us, you know, a year to do that, but you can in your own studies. And in fact, it's better for you to do it rather than me showing you all of it. I'm showing you the basics of it, but you want to go and put some flesh on it now. You want to make it your own, and in doing that, you'll be more confident in taking those trades, and you'll be, more sharp in being able to identify them, more quick in being able to identify them, and you'll have some nice trades for yourself and some nice trade setups. So if you think about going back through now and maybe reviewing what I said, but kind of as a summary here, a couple of the things that we've talked about are that we look for weakness at the top of a trend, and we can use trend channels to highlight when we're near a trend top, right? But we want to see that change of behavior coming in. That would be nice to see, or at least we see the supply coming in around the top, and that would be evidenced by perhaps some climactic action of a widespread bar up there going into overbought or on the downside oversold conditions, some climactic action, or if there's no climactic action, to see some supply coming in with the high volume followed by the no demand or the no supply if it's to the downside. And then you can look for an opportunity to go short in that area. That's one idea that you can pull from tonight. Another idea is probably a safer idea is after the change of behavior occurs, after the supply comes in and we break down through the trading range, and then we see the inability to rally very high after that, and we look for an opportunity to go short in the same area where we saw high supply. Okay, it's a second idea for you. A third idea is when we break out of a trading range and then we come back in and test that breakout. Not just the demand area or the supply area, but actually come back down and test like in here. We saw a couple of examples of that tonight. That's another option for you. A third option is to find to the downside, climactic action to the downside that gets resolved in a spring, or gets resolved in shortening of the thrust. Remember the price bars that don't have a lot of downside afterwards. Okay, and then another idea is this accumulation. So I didn't show you specific trade setups. That's not the idea of this. That's not the job of this. That I want you to do some work for yourself. Trading is hard work, and no one's going to hand it to you on a platter. It just doesn't exist out there. You have to go back in through your charts and think through, okay, what did I learn from this guy tonight? What did I learn about price bars and volume? Well, the high volume is important, the spread's important, and where we are in trends are important, where we are in trading ranges are important. So how can I use that information to create trade setups for myself? And what are the things I'm going to look for? What are the criteria that I'm going to want to have in those trade setups? And then go down and do the work for yourself. And don't try to have it done by a computer. That's not going to help you. Do it by hand. That's really going to be helpful for you. And then you've got trade setups that are yours and that are based on good sound. Everything I've told you tonight are very good sound principles of market behavior and market action. And so, starting to look at that for yourself, now you got something. Now you're a trader. Now you got a trade setup that's yours, no one else's, and that's nice. That's being a real trader. All right, so a bunch of questions, and I'll get off the soapbox. Is S&P price action very similar to the yen or the euro currency? Yeah, it is. It's fairly similar. It's more active than either of those markets. And I think it's more clear, the so-called signals that's set up of supply and demand are a little more clearer, I think, than in the yen, certainly in terms of the euro currency. What's the high volume bar in the middle? in the middle of what, I'm not sure what chart we're talking about because I jumped around here. You might have been back on a different chart. Could you see that accumulation has changed to the downside or change of sentiment? Does it always continue the trend? Well, Marilyn, if they're holding here and they're not letting it go down, then it has to go up, you know? I mean, that's the logic behind it. So, yeah, generally the accumulation is gonna resolve to the upside. I mean, if you're reading it correctly and if you're pretty confident in the accumulation, then it will resolve to the upside. But remember, we don't want to just say, okay, this is accumulation, let's put our trade on and then, you know, take a vacation. You want to actively manage this. So what are you looking for next? You're looking for it to break through, you're looking for it to mark up and break through the high, and you're looking for it to do it on good volume and good spread. If you don't get that, something's probably wrong. And you may not have read it right, or possibly things have changed. So you want to, I mean, if you're reading it right, you should be okay. But you want to know what's coming up next too. Okay? If you're not getting that, then you've got to reassess what you're thinking about. Where should one establish a long? On the right at C, on the close of C. That's where I'd be. And maybe watching this intraday if I were thinking about it, if I were actively trading that. Can I look at the live 5-minute S&P chart? Not tonight, Paul. We're 2 hours or almost an hour over what I said I'd do. Does the spring have to be a single bar? No, it can be a couple of bars. Usually I like to see them no more than 3. You kind of have a situation here where it's just chopping along. You got 4 or 5 bars here. That's sort of an outlier, but obviously it worked out okay. Can it be over 2 bars? Yes. Can it be a red candle followed by a green engulfing candle? I'd get off of the candles, but yes, it could be that way. Do you trade more on breakouts? I trade the pullback on a breakout, not breakouts themselves. I am usually, for example, Marilyn, I'll go short or I'll go long in here, say either here or this is a no-brainer right here to go long here. And then I'm looking for the market to break out and push up. If I don't get that, like let's say for example I went long, I'll try to explain this. Let's say I went long here, okay? For whatever reason, I'd say, okay, well, we're on top of support, and so we got a nice bar here, so let's go long. So I go long here. Well, if I'm looking at this bar, I'm not happy with this trade. There's something wrong here. And so I might start to think about pitching it out, or certainly here, if I did hold it that long, which I probably would not, I'd probably be out on this bar, but certainly by here, I'd be out of this trade. And I'd just scratch out of it. You know, I didn't make any money, but I didn't lose any money. So what? So I'm trying to buy on the pullbacks, the reactions, and not on the drives, either up or down. I'm trying to buy the pullbacks or sell the pullbacks, and then look for the breakthrough. So, for example, if I bought this in here somewhere, this is what I want to see. That's perfect. Okay, that's what I want to see. Is a drive up above the last swing high. In current slide, what is happening on the October high volume bar? Shake out to the downside. It's, you know, you wouldn't know that to begin with. You would say, okay, possibly a change in behavior. You might even short this, but down here you're getting very light volume, so there's no downside follow through. And you're on a weekly chart, so you want to look at this at least on a daily to get a bigger view, but I'm sure that you're not getting much volume to the downside here. Sharif, every lack of follow-through is a turning point, or is it more important near support and resistance? Well, I'll give you a hint here. Every lack of follow-through is going to be a turning point. The best ones come when you can say, here was resistance that turns into support, and then you get this kind of setup. This is like picture perfect. It's almost picture perfect. So when you can find something like this, I love this look. This is probably, this is one of the high probability trades, the highest probability trades that I know. The other one is the first pullback after a breakout. So the other great high probability trade is this one right here, where we have the breakout and then we get that first pullback. That's always good for a push above the previous bar's high, the previous swing high. For Saturday class, please include volume bars, as I do not have Weiss wave. Thank you. Yep, no worries. We're going to continue to do that. We're not going to go too deep into the Weiss wave. Just a little bit more. Glad you like it, Marilyn. For what it's worth, you may want to stop the recording soon. It's been my experience that the rendering of the video can run into problems. Yeah, okay, we're going to do that. Okay, so let me suggest this for you. I'm sorry I took us over by an hour, but we're done for tonight. And the next session will be Saturday, January 25th at 4 o'clock. That's this Saturday, 4 o'clock Eastern Time or New York time. Okay. Going to be tough for you folks in the Far East, in Asia, but it'd be better for the European folks. And I tried to balance it a little bit. It's tough for the Europeans tonight, and better for the Aussies and the folks in Asia. But we're recording, so you'll have that for the recording. And I'd like, if you have any questions, here's a couple of questions that I'd like to ask you. What situation causes you difficulty when you're trying to read bar by bar? Or alternatively, what would you like to know about? What would you like to know more about in bar by bar chart reading? Okay, so you can ask me those questions and I'll try to compile some stuff for us on Saturday. Now, for me to do that, I'm going to ask you to do two things. One is, don't give me a dissertation about it or a thesis. Just a couple of notes and use a chart if that's helpful, okay? For example, you could say, well, this situation gets me in trouble and it happens all the time. I think it's good to go short, but it turns out that it's not a good spot to go short. Can you illuminate? And here's an example in a chart where it happened to me last week. Then that's great. I can do that. But if you give me like 3 pages of, well, if it's the large bar here and we've got high volume there and it's all these words, I'm not going to be able to get through it. Okay, so I think you understand what I'm saying. Don't give me an extensive written description. Just a few notes and try to use a chart. And the second thing I would ask is you get it to me by Friday, 5 o'clock Eastern time, so that I have time Friday night and Saturday morning to put something together for you. I can't do it if it's coming in at 3:30 on Saturday. But I'm happy to try to do this for you. If you've got good questions, I'll try to address them. But please get them in by Friday at 5 o'clock Eastern time, 5 o'clock New York time. Okay? All right. I'm going to be busy changing my candlesticks to bar charts. Good. I'm glad to hear that. That's great. Oh, this recording will be ready probably in a day or so. All right. I think that's about as much as I can do.